Good afternoon, everyone, and thank you for joining us today for this important discussion on ISO's emerging standard for net zero transition planning in the financial sector. I'm Daan van der Bekken. I'm the head of sustainability at BSI, and I'm delighted to be joined today by Mark Manning, our ISO working group convener, and Paul Pritchett, our ISO technical project lead. We're also joined by our amazing panelists from IIGCC, from TPI, the Transition Pathway Initiative, and from the Central Research Institute of Electric Power Industry in Japan. And Mark will introduce the panelists in a moment. So together, we're really excited to share the purpose, the value, and the progress of this global initiative, and particularly how you can help shape it. Excellent, thank you. So here's the agenda for our session. Thank you. We'll begin with a brief introduction to BSI and our role in the international standard system. We'll then provide context on why this standard matters and what it aims to do. And next, we will walk you through some of the key features of the transition planning standard, after which Mark will lead us to the heart of the session, the panel discussion. And finally, we will outline how you can engage in the consultation phase to help us refine the final version. But before I start with the session, and that's the slide with the housekeeping, please. Thank you. Before I start with the session, I just want to inform you of some of the housekeeping. This is a listen-only webinar. It's being recorded, and there will be an opportunity to ask questions during and after the panel discussion. Now, please share all other questions and all other comments in the chat. What we will do is we will collect them. We will get back to you after the webinar. We will also include the questions in the live FAQ document that will be available on the Transition Finance website. Now, I appreciate that's a lot of information. So what we'll do is after the webinar, you'll receive an email with the link to the recording, a link to the website, and to the FAQ document I just mentioned. And then finally, we aim to finish at 2:15 UK time exactly. Let me start, and that's the next slide, with an introduction to BSI and ISO. So, can I have the next slide, please? Thank you. So, for those less familiar, BSI is the UK's national standards body. We are independent of government and industry, but we operate under a public interest mandate. And what we do, BSI helps to convene global stakeholders to create voluntary standards that promote best practice, support the delivery of government policy, and importantly, build trust. And in our function as the national standards body, we publish over 3,500 standards each year, and all those standards are underpinned by a collaborative approach where we always aim for consensus. So we operate in the national interest, but with global reach and impact. And I think it's really key here to understand that we are impartial, independent, apolitical, and profit for purpose. Next slide, please. And then, as the UK's national standards body, we represent UK economic and social interests across all the European and all the international standards organizations, including ISO, the International Organization for Standardization, but also the International Electrotechnical Commission and European standards organizations like CENELEC and ETSI. So BSI really is the voice of the UK in international standards development. Next slide, please. Now, when we started this program about a year ago, and during all our engagement with financial institutions over the last year, two questions kept coming up. The first question is, how does the international standard system distinguish itself from other standard setting organizations? And the second question is, what is actually the additional value of an ISO standard for me as a financial institution? So I'm just gonna, in the next couple of minutes, just gonna spend a bit of time to elaborate on these questions. When we talk about the value that ISO bring to emerging and existing guidance, we're really talking about 5 key pillars. The first one is around global legitimacy and recognition. ISO standards are internationally recognized and used across more than 170 jurisdictions. They're trusted by both developed and by emerging markets. And importantly, what ISO does is they bring stakeholders together to agree the best way to do something. And that gives real authority and consensus to the standards. Secondly, ISO standards are inclusive and consensus-based. They are built through a balanced global process. They ensure equal input from different regions, different sectors, and different stakeholder groups. They really make sure that developing and emerging markets have an equal voice. We're a bit like the United Nations of standards. And that inclusiveness builds stronger and more practical and more widely accepted standards. The third pillar is around independent assurance. ISO standards are supported by a trusted global ecosystem, what we call the quality infrastructure. And that includes ISO's Conformity Assessment Committee, and it includes the International Accreditation Forum. So those pillars of conformity assessment, accreditation, and standards development, they provide an independent, credible, and consistent assurance. And that gives users and stakeholders trust in the process and the claims that are built on ISO standards. The fourth pillar is around regulatory and policy relevance. ISO standards are embedded in legislation, in regulation, and in procurement practices worldwide. And that means that ISO standards often help to support harmonized implementation across jurisdictions. So ISO standards are aligned with and can reinforce regulatory expectations. And finally, real economy adoption. ISO standards are not theoretical. ISO standards are widely adopted across all industries. I'm just going to give you one example around ISO 9001, quality management systems. There have been over 1 million certificates issued across more than 170 countries. ISO 9001 is the most widely adopted standard in the world. And this real economy connection also ensures interoperability, and it will reduce fragmentation across international markets. So that's a bit about the 5 key pillars under the international standard system. Now, the second question, and that's the next slide, thank you, is what is the added value of an ISO standard, and why should I, as a financial institution, adopt or implement this particular ISO standard? First of all, ISO standards complement existing frameworks. ISO standards do not compete, they complement. And there are 3 important areas where this particular standard will add value. The first one is around embedding. What the standard does is formalize existing practice and already widely used and accepted frameworks, like the Defense Transition Planning Guidance and like IIGCC's Net Zero Investment Framework. The standard embeds key elements from these frameworks into ISO's globally trusted quality management ecosystem. And the standard will really help financial institutions to embed transition planning into their day-to-day operations, governance, and decision-making. And then, through independent assurance against the standard, demonstrate that they have done so. Secondly, it's about complementing. So this ISO standard, the proposed ISO standard, is designed to connect with and to complement other relevant standards in the broader ecosystem, including disclosure standards from ISSB and from the TPT, including target setting standards from, for example, SBTi, including the forthcoming ISO Net Zero standard, and DHC emissions accounting and measurement standards. Importantly, the standard is also capable of being applied in the context of jurisdiction-specific regulatory frameworks. And finally, supporting. So this standard, the proposed ISO standard, will give financial institutions a way to communicate their transition planning activities with greater credibility. Because by demonstrating structured, rigorous, and independently assurable processes, a financial institution can reduce external risk perceptions and therewith strengthen market confidence. So in short, ISO does not replace existing guidance. It complements it, it connects it across the value chain, and it offers a seal of quality through independent assurance. That's in a nutshell the ISO International Standard System and how this particular ISO standard will add value. And with that, I'm going to hand over to Mark, who will say a few words around the role of financial institutions in the climate transition. Mark, over to you.
Thank you very much indeed, Dan. It's a pleasure to be here this afternoon, and it's been a real pleasure to act as convener for the working group that has been developing the ISO standard for net zero transition planning for financial institutions. I'm going to just kick off with a few scene setting remarks around why we have at ISO developed a dedicated standard for financial institutions in this space. If we could go to the next slide, please. So the motivation for doing this is the recognition that finance has a critical role to play in enabling and accelerating the climate transition. We've all heard the big numbers around the magnitude of investment needed to support the goals of the Paris Agreement. They're of the order of 8.5 trillion annually by 2030. So private capital will need to be mobilized at speed and at scale. Sitting at the center of the economic system, financial institutions, of course, have connections to businesses and households right across the economy. Their position at the center of this system gives them significant influence and unique agency. Their actions can have an outsized impact, underpinning wider economic and societal resilience and accelerating the pace and the scale of the climate transition. And at the same time, financial institutions' exposures across the economy also make them vulnerable to growing climate-related risks across their investment, their lending, and their insurance portfolios, especially as physical climate risks begin to crystallize. And that's why leading financial institutions are increasingly considering how setting strategic transition-related objectives and developing transition plans to achieve them can help them respond and contribute to global climate goals, while at the same time managing climate-related risks and capturing opportunities. Core to financial services firms' transition strategies will be how they can help their clients navigate the transition and how they can help their clients maintain resilience to a changing climate. And as part of this, firms are recognizing the resilience benefits and the commercial opportunity, and indeed imperative, of scaling finance to support the global transition to a low emissions, climate resilient economy in line with the Paris Agreement. The growing focus on transition planning and, by extension, transition finance has been an important evolution in the green and sustainable finance narrative. Previously, this has been focused primarily on financing activities that are already green or sustainable. But we have to recognize that an exclusive focus on such activities can be counterproductive. It can withhold much needed capital from emissions-intensive entities and activities that desperately need finance to decarbonize their operations. And this opportunity of transition finance and this imperative has been recognized in the work of several important industry initiatives, GFANS and IIGCC, for instance, government and regulatory-led initiatives in several jurisdictions. We're going to hear from Japan in the upcoming panel session, and in the UK, we've of course had the Transition Finance Market Review, and many of the recommendations of that review are being taken forward by the new Transition Finance Council. So as climate change transforms both the narrative and the operating environment across the financial services ecosystem, firms need to consider how setting net zero objectives and targets and embedding these in their risk management and financing decisions can help them protect and enhance long-term value. So it's against this backdrop that the work has been done to develop the ISO standard on net zero transition planning for financial institutions. And this work is really aiming to set out how firms can establish a rigorous process to set their objectives and targets and develop their plans to respond and contribute to the transition towards a low emissions and climate resilient economy. And I'm now going to pass on to my colleague Paul Pritchard, who has been the technical lead for the ISO standard, to give a little bit more colour on what that standard includes. So over to you, Paul, and thank you all for listening.
Thanks very much, Mark, and hello, everyone. I'd just like to say how pleased I've been to act as technical lead on this work. It's very much about supporting the working group, who actually should get all the credit for developing this draft, taking the whole process forward. What I'm going to do is talk through a couple of slides that actually got some more of the detail on the actual content of the standard, starting off with some of its attributes, and then a diagram produced by the working group that I think is quite helpful in understanding its overall aims and objectives. So the next slide should have some information on the purpose and attributes. So I think the first thing to note, and we've italicized it there, is that it's actually about transition planning. And I know a lot of initiatives are focused on plans and disclosure. As Dan mentioned, one of the things about this work is that it aims to build on and complement existing guidance, a lot of which is focused around the disclosure requirements. This one is about internal processes, having internal processes that deliver effective transition planning. It builds on, aligns with the material, again, as Dan mentioned, the existing guidance that's out there. There is a lot of existing guidance, as I'm sure you know, and there's also quite a lot of commonality between that, and it's been the working group efforts to get the key elements in that reflected in the standard. It's very much focused on the aims of the Paris Agreement, so it adopts a common but differentiated approach, reflecting national and jurisdictional requirements, pathways, guidance, and so on. And as Mark also mentioned about the need to think beyond decarbonisation. And we've seen moves towards extending guidance beyond consideration of decarbonisation. Obviously, that's essential. And this draft actually includes adaptation in there. There's particularly the physical risks associated with adaptation, and also having to take account of broader issues, social issues, and nature-related issues. It is drafted with input from multiple jurisdictions reflected in the working group, and it is intended to be applicable to all organizations within all jurisdictions. So that would be the kind of big three around insurance, investment, and lending, but also as well it recognizes the sort of emerging tech-based financial institutions as well, and wants to address the issues relating to them. Dan mentioned about the existing extensive ISO infrastructure, the certification process for example, existing standards like ISO, environmental standards like ISO 14001. I think there are about 500,000 certifications in place. So I think that ISO existing infrastructure certainly supports scaling efforts, and it also offers the independent and transparent third-party assurance that I think is probably a key issue for organizations that have already got existing transition planning elements in place. There's very much a focus on integration of transition planning into existing processes and practice. So it's meant to ensure that transition features in all financing and risk and financing decisions. And as Dar mentioned at the start, it actually fits within and complements existing ISO standards, such as the ISO net zero standard that's currently being developed as well. A number of those will be particularly relevant to rail economy organizations. So what we will have is a system that has the finance sector and the rail economy using the same kind of terminology, references, definitions, and so on. On the next slide, we've actually got a diagram, as I said, that the working group developed. And we're actually seeing the transition process as a kind of iterative process, and finding that it could actually be well described as a kind of circular flow or a circular process. I know other standards like TPT have adopted that. So we're actually starting here. We're not actually dictating that people need to follow it round exactly like this, and people may well already have existing elements in place. So it's not that dictating, but we start from a forward-looking assessment of the climate-related risks and opportunities. So the requirement for scenario analysis, including physical risk, is a key requirement on there, and development of an emissions inventory as well. Using that and building on jurisdictional specific pathways is the requirement to build an organization specific pathway, and from that, objectives and targets that link to and deliver the pathway. There's also consideration of residual emissions and how carbon credits might be used in the context of dealing with residual emissions as well. I mentioned before that about integration into kind of routine financing decision making, and that's another element where we see it building into routine risk management activities, identifying the transition related attributes of products and services. That might be by using taxonomies or labeling, and also the importance of engagement activity with a kind of dual aim of understanding the risks associated with rail economy counterparties, but also the engagement activity as one of the levers that the finance sector has to promote the transition as well. On the next step in the cycle, this is kind of where it complements existing disclosure related guidance. There is a requirement to communicate the progress that's been made with transition planning, both externally and internally as well. So the engagement with the workforce is also a key element. And on the next step in the cycle, we actually move on to something that I think is probably less familiar to people who are maybe following some of the existing guidance. And this feeds into the sort of ISO certification requirements as well. So there's a need to have an internal assurance process, something akin to an internal audit, that specifically addresses elements around transition planning, with corrective actions arising out of that and being dealt with and documented. And there's also, importantly, a requirement for a senior level annual, at least, management review that reviews the overall effectiveness of the transition planning system, and whether it's delivering the objectives and targets, whether there are changes in external circumstances that require addressing, and so on. And so in that way, it's seen as an iterative annual cycle with assurance and certification built into that. And I think overarching it all, we have put in the center here elements that I think people will be familiar with from other standards, overarching governance applying to the transition system around senior level accountability, remuneration, skills, resourcing, and so on. And also the need to maintain appropriate documentation to facilitate third-party assurance. So I think that's a very brief run through some of the elements in the standard. And I think if people have other questions, we can pick them up in the panel, and the FAQ actually goes into quite a bit more detail about that. So with that, I'd like to hand back to Mark, who's going to now pick up the panel discussion, I think. So thank you, Mark.
Wonderful. Thank you very much indeed, Paul. Well, we've now come to the heart of the session, which is the panel discussion. And I'd like to invite panelists to turn on their cameras. I'm delighted that we've got a fantastic panel with us today. We have Valentina Ramirez, Head of Climate Strategy Implementation at the Institutional Investors Group on Climate Change, IIGCC. We have Valentin Can, Senior Policy Fellow and Deputy Director of the Transition Pathway, or TPI Centre at the London School of Economics and Political Science. And we have Motoshi Tomita, Research Scientist at the Central Research Institute of the Electric Power Industry in Japan. And when we get to the Q&A, Paul will rejoin us in case there are any questions on the standard itself. So welcome all of you. Thank you so much indeed for making the time to join us today. We're really looking forward to your insights. So maybe we can just start to kick us off. Perhaps each of you could briefly introduce yourself and your organization and give a little bit of context to your interest in the topic of transition planning for financial institutions and your engagement with the process so far. So perhaps I could turn to Valentina first. Thank you very much indeed.
Thanks, Mark, and thank you for the invitation. So as you just said, I'm Valentina Ramirez. I'm the Head of Climate Strategy Implementation at IIGCC. So IIGCC, for those who are not familiar with our organization, is the Institutional Investors Group on Climate Change. This is a membership body convening and collecting the voice of more than 420 institutional investors. This is asset owners / pension funds, asset managers, and what we call associate members, who are, for example, index providers, data providers, and other service providers in the industry. Our members are mostly based in the UK, Europe, and substantially more in the US as well. But most of these institutions actually do have global reach, with some actually in the emerging markets. So we have indeed co-developed with our members a couple of frameworks, which I will perhaps expand on later questions, but these are the Net Zero Investment Framework, the NCIF, and the Climate Resilience Investment Framework, the CRIF. I now work with institutional investors, but in my initial career, I worked for Colombia's largest bank, Bancolombia, in the investment banking teams, and I was serving the financial industry. So I'm personally quite excited to see more tools and standards that help this relevant industry accelerate the transition. And perhaps just to finish, which is now a very long introduction, last thing to mention is that my colleague Adrian Fenton, who leads our frameworks team, has supported the ISO technical development as well as the UK TPT framework, which ISO took some inspiration from. So there's a lot of connection, and that's precisely one of the strengths, as we'll come to discuss in a second. So over to you, Mark, and thank you.
Wonderful. Thanks so much, Valentina. Valentin, would you like to say a few words by way of intro?
Thanks, Mark, and yeah, really delighted to be here. I'm Valentin Jan. I'm Deputy Director for Research and Operations at the TPI Centre, based at the London School of Economics. The TPI Centre provides independent and transparent assessments of how companies and also financial institutions are aligning or not aligning with the goals of the Paris Agreement. So all of our work is publicly available on the website, and we have for every corporate that we cover, including banks, an assessment. The work is designed to support investors, policymakers, and other stakeholders with a clear and publicly available data on transition progress. We started in 2018 by assessing corporate decarbonization plans, so what are corporates doing, and the alignment, crucially, also of the targets that are being set. So do they align with a 1.5 degree scenario or similar? Since 2018. And in 2022, especially with the Glasgow COP, we started a dedicated program focused specifically on the banking sector. And Valentina, you mentioned some of the work that IIGC has done, and we have worked quite closely on that with IIGCC. So the Net Zero Banking Standard that IIGCC published was sort of a co-product. Our interest in the transition planning for banks specifically relates to their central role in the economy, as has already been mentioned. So exposing banks to significant risk, but also opportunities. And we believe that a credible, structured, science-based plans are essential for investors to gauge and understand the transition that these institutions go through, and with that the risk and opportunity that they're exposing themselves to as well. Thanks.
Wonderful. Thanks very much, Valentin. And TPI's support during this process has been really valuable. Thank you. So, Motoshi, please, a few words of introduction. Fantastic to have the Japanese voice on the panel today.
Yep, thank you for having me. My name is Motoshi Tomita. I'm a research scientist at the Central Research Institute of Electric Power Industry, which is kind of the lengthy name of research institution, which is funded by 11 large Japanese power companies. My institution is a primary technological research and development organization, but as I'm belonging to the policy divisions, so I'm working with the climate policy and the nature policy, particularly focusing on financings. I'm engaging with both of the industry and the government to design the appropriate the policy to the policy for the appropriate climate policy regarding the transition, the financing transition. We have engaged with we have been engaging with the Japanese government to design the idea of the transition finance since 2018. The very early stage of the climate financings. Now, as Mark country introduced, Japan has one of the first countries to elaborate the idea of the financing transition. So I'm very honored to contribute a Japanese perspective to the international discussion. Thank you so much.
Wonderful. Thank you very much, Motoshi. Thank you to all of you. So let's get into it then. Valentin, perhaps we can start with yourself. So as you mentioned, TPI has been assessing the state of the transition for a number of years now, and within financial services, you have been running this dedicated program in the banking sector. I think your most recent report back end of last year concluded that most of the banks assessed are still actually quite early in their transition journeys. I wonder if you could perhaps give a little bit of an overview of the findings of the work that you've done on the banking sector. Where did you find the most significant gaps, and what are the potential challenges and shortcomings, and how can the work that ISO has been doing here potentially help? Grateful for your thoughts on that. Thank you.
Thanks, Mark. And indeed, I think, I'll come to this at the end again, but ISOs, I think, will play a really crucial role here. But maybe first explaining a little bit the headline result that you just already presented, and to explain how we reach how we do our research. So we look at banks transition in two ways. On one hand, we have a qualitative framework consisting of 72 indicators covering topics such as net zero target setting, emissions disclosures, but also executive remuneration, governance, just transition, etc. And on the other hand, we have, so this is the transition plan essentially. And on the other hand, we have a quantitative assessment of the alignment of the targets that come out of this whole process and whether they then will actually be sufficient to meet certain global carbon budgets. So as you said, the overarching result is that banks tend to be quite early in their transition journey. We overall, across the 26 largest international banks that we cover, so these are your JP Morgans, you know, we have banks in North America, Europe, Japan, China. We also wanted to get some regional breadth there. Is that they meet around 20% of the indicators that I just mentioned on average. We have one bank that achieved 40%, so no bank achieved more than 40%. And then on the alignment of the targets themselves, we find that 19% of sectoral pathways that banks have thus far defined are aligned with below 2 degrees in the medium term, and only 3% with 1.5 degrees. What explains these results? There's sort of broadly speaking two buckets. The first one is what I call the yes buts, and then the second bucket is a general like across all banks. So the yes buts are basically things where banks have started doing things, but for example, they only cover certain parts of their business or only certain sectors, etc. So just to give you some examples to put some color on this, most banks have set the net zero targets, so 21 out of the 26 large international banks, but none covers all banks' activities, and only few discover, which disclose which business coverage, which business activities are covered at all. Most banks are now disclosing their financed emissions. That's quite common in the European and Japanese banks, but again, it's unclear often which kind of business activities they relate to. On sectoral decarbonization targets, again, we find 21 banks have set at least one target, but that leaves for one sector, but that leaves a lot of sectors that are not covered. So most of them will have a target for the electricity or the oil sector, but cement, steel will not be covered. For the banks that we do assess, we find that on average, 22% of their revenue is covered by targets. So relatively low. Many banks now recognize climate risk at the board level, but few tie executive remuneration to it. Most banks have some form of climate solutions targets, but they usually don't follow a clear definition of climate solution, for example, or it's unclear how that relates to the bank's total business. I could go on, but basically this is the yes buts. So you have a good start, but if you start looking at the details, there's a lot of work that still needs to be done. The general lack category are things that basically no one's doing. And these are really crucial things related, especially to implementation. How do you actually reach your target? So transition finance, we do find some policies there, but they often lack any kind of form of enforcement. So there will be an assessment of the alignment of a corporate, but it's unclear what will happen if the company is not aligned. We find basically very, very few coal, oil, and gas policies that are adequate. And basically what we find is that most of those banks continue to finance oil and gas and even coal projects. Just transition is mentioned is mentioned quite frequently, for example, in Europe, but there are no specific commitments or even concrete actions associated with that. We have no commitments to align lobbying with 1.5, although we find lobbying positions on other topics, but particularly none on climate so far. And yeah, poor incentive structures, as I already mentioned. So I think just coming to your last point on the ISO, where does it fit in? I think it's really crucial because banks are still quite early. We're talking about the largest banks in the world here. So it's really important to broaden the tent, take a lot of those learnings, because there's been a lot of organizational learning also going on across the ecosystem, actually. And then also for those banks that are already on the journey to have a clear roadmap and be able to communicate that clearly is really crucial.
Amazing. Thanks very much indeed, Valentin. That's really set the scene nicely and given us a sense of where even some of the largest financial institutions are in their journeys. Valentina, I wonder if we can sort of turn to the investment sector now. As you mentioned, IRGCC has been playing an active role in embedding a transition focus through initiatives like the Net Zero Investment Framework. The work to develop this ISO standard has been informed by IIGCC's work in respect of the NZIF, among others. How do you see the forthcoming standard complementing your work and indeed complementing other tools and frameworks for transition planning in the investment sector?
Yeah, thanks, Mark. So perhaps a bit of context on what NCV is and it's not, I guess. So the net zero investments framework, it's a framework co-developed with our members, whom I mentioned and you mentioned are the investment industry, so pension funds, asset managers who work for them or enact their strategies. It's not therefore a standard or an initiative or a protocol. It's rather we like to call a collection of good ideas or recommended action points as we technically call them, and they're stemming directly from industry practitioners. So in that sense, it's perhaps a softer framework than a standard, and that gives you an idea of how it can be complementary as well. It was designed in in 2021 or perhaps a bit before by institutional investors themselves, pension funds themselves, to support the industry reach the Paris goal and how they could reach net zero by 2050 or sooner. And it has broadly two overall objectives. One is the real world decarbonization as opposed to portfolio decarbonization and mobilizing investment into climate solutions. So also terms that are across the standard. To speak about the complementary aspects, one is that we've heard from our members that they often struggle in terms of the scope of the assets that they can actually embed to net zero investment policies, and NCIV actually applies mostly at portfolio or fund level. We have actually also produced some guidance to support asset class within that fund level, but the ISO standard can in fact give some clear guidance at the entity level, which perhaps not NCV is not directly leaning towards. NCIV broadly supports internal policies and processes, engaging with policymakers and engagement throughout the ecosystem. So service providers and index providers, as we mentioned. I guess the other thing to mention, and which explains why the framework has been so popular, is because it's not an overly prescriptive framework. NCIV, we call it implement or explained, a framework to implement or explain. So basically, that allows us members to apply certain elements depending on their context, their resources, their mandates, and their reach. So again, kind of loosely speaking, whereas a standard already perhaps adds a little bit more of accountability, I guess, to it. Yeah, and they're complementary as well. They, as I mentioned before, they have some shared underpinnings in the UK TPT. So I guess all of these frameworks can support asset owners in their due diligence process to their asset managers. So again, as I was mentioning, more guidance at the entity level, whereas NCIV provides more guidance at the fund and asset level. I'll leave it at that for now.
Brilliant. Thank you very much, Valentina. So, I mean, just building on that, given that the focus of the standard is very much around building and supporting a robust and credible transition planning process that takes objectives and targets and translates them systematically into risk and financing activities, how do you expect IIGCC members to apply the standard in their activities?
Yeah, I guess the first thing is to reinforce what has been said. They're mutually supportive, and that's good. We didn't find any material elements of difference or disagreement, so it's great that they're all going in the same direction. I guess, as I noted before, NCIV does provide specific guidance for institutional investors, meaning asset owners, asset managers, and we have a separate guidance for banks, as Valentin mentioned, co-developed with TPT. So speaking of that, we do see a value in having separate guidance or separate elements for both investment side and banks and perhaps also insurers. So there's a balance, I guess, to consider between the breadth and the reach and the detail and level of granularity that you do need to to assess distinctively these three big pieces within the financial industry. So yeah, as I said, there are elements of that due diligence process that perhaps must be specific for each type of financial institution. That said, the ISO standard is close enough to support this process at a broad level. So it does provide sort of high level enough that can be applied across all these different institutions. I guess the other point is to do with the extent to which adaptation and resilience is integrated in full depth. There's enough mention on sort of physical risk elements as well in the standards. We have so far kept them separate. So we have the NCIP for net zero mitigation, and then we have co-developed recently the CRIF to keep the adaptation and resilient aspect sort of separate to give it enough depth. However, we're keeping the same structure and the high level levers, meaning internal direction at portfolio structure, so the governance bit, the second lever being the alignment of the asset themselves. So when I was talking about asset level guidance, so giving certain particularities that certain asset classes have, and different levers that investors can have across different asset classes, and then the influencing of the external environment, what has been termed macro stewardship in general. So we're keeping the same structure to make it easy, and I guess who knows, eventually we'll merge them, but we've seen value in keeping them separately from now. And perhaps a third element, and I'll finish with that, is the growing awareness of the need for a third party verification. So the fact that the ISO standard is a standard and talks about entity level, can start to provide some potential support, as you yourselves have pointed out.
Wonderful, super helpful, Valentina. Thank you very much indeed. Let's turn to you, Matoshi. As has been noted a couple of times now, Japan has been a leader really in global thinking around transition finance. So it's been incredibly valuable to have your perspective on the working group. What's your take on where financial institutions are in their transition journeys in Japan, and how can the ISO standard fit with domestic regulation and practice in the Japanese context?
Yep, thank you so much. So what is the state of the Japanese financial institution in terms of transition finance? As you noticed, many major large Japanese financial institutions, regardless of the sector, banking, insurance, asset manager, and asset owners, most of the major financial institutions have already committed to net zero by 2050s and set interim targets aligning with net zero scenario, like for example, 50% reduction for the financial emission by 2030, like that. But problem is this kind of the ambitious target sometimes conflict with the real economic needs. So the decarbonization of the entire economy requires a massive capital toward the high emitting sectors, but such a sector cannot reduce emissions as expected in the net zero scenarios. So this is a problem. And another problem is the country-specific circumstances. So, Japan is island institutions, heavily relying on the fossil fuel imports. So that, but Japan also cannot sacrifice its economic prosperities, energy securities for the climate ambition. This is a problem. So we need a real solution. That's how Japanese governments and Japanese financial institutions, Japanese industry have develop the idea of the transition finance in the early stages. So we started on such a discussion in 2018, and in the 4 years ago we published the first basic guidance for the transition finance, and this guidance actually revised in this March to reflect the recent market development. So we have the basic principle guidance, so that's all the financial institution can refer to. Then also we have the set of we have the toolkits, for example, the sector-specific technology roadmaps for high emitting sectors, and the follow-up guidance for the post-financing monitoring. So this is engagement guidance between the financial institution and the investing companies. So we have the plenty set of the tools and the principles to support the transition financing transitions. So with regard to the relation to the new ISO standards, we see a lot of the similarity to Japan's approach is the new ISO standards. So which is obviously more beneficial to the Japanese financial institution to become more confident in their strategy to financing the high emitting sectors. So for example, the Japanese guidance recommends the companies to disclose their transition strategy and governance frameworks, and also recommends considers environmental materiality in their use of proceeds. This principle aligns with the ISO standards approach, which encourages the financial institution to analyze their own risk and the opportunities and reflect them in the financial decision makings. Also, the Japanese basic guideline recommends companies to develop the strategy and targets based on the scientific foundation. So this scientific foundation may refer to the net zero, global net zero scenario, like IEA's net zero 25 scenario, but it also allows to use jurisdiction-specific pathways such as a national determine the contributions or sector-specific technology roadmap. So in Japan, Japan developed a sector-specific technology roadmap for the 10 hard-to-abate sectors, for example, power, including the power, oil and gas, iron, steels, and maritime shipment, for example, which elaborate type of technologies and timelines of the anticipated deployment up to the 2050, so that the financial institution can refer to such roadmap to elaborate their own strategy and targets. So, and finally, I'd like to stress that decarbonization is not one size fits in all exercise. So the pathways differ by countries and regions. So the good point of the new ISO standard is the aligning accommodating such as regions accommodating the various regional circumstances, so that's so it's useful not only the financial institution like Japan, but also beneficial to the financial institution, emerging economies, where not necessary to the committed net zero targets, the policy, they also they're expected to the growth, increase the GHG emissions near terms.
Brilliant. Thank you very much, Matoshi. I think that point that you've just been emphasizing there about sort of jurisdictional circumstances and the importance of tailoring to those, that's been a really quite prominent point of discussion within the working group. And certainly there's quite a bit of emphasis in the draft standard on reference to national pathways and translation to sector-specific pathways across jurisdictions. I think this has all been in the direction of trying to ensure global applicability of the standard. But of course, there's always a bit of a trade-off between being specific enough to be robust and credible, while at the same time flexible enough to accommodate a variety of different circumstances. I wonder if I could just get a quick view from both yourself and Valentin around whether the standard strikes the right balance on that, and as a result, can be applied effectively in both advanced jurisdictions and emerging market and developing economies. Perhaps I could ask you first, Valentin, and then Matoshi, perhaps you could say a few words on that as well. And then we'll go to the Q&A, because we've had quite a few questions coming through. So Valentin, please.
Of course, thanks, Mark. And I mean, this is a huge question. This is sort of the crux of the whole COP negotiations, right? So who does what? But I can just sort of offer my observations and where I think the ISO standards fit in. So at the basic issue, you have the global carbon budget, the global problem, and you need local action to solve it. How do you bring those two together? Who needs to move when, how fast, in which sectors? So, and in a way, like I just said, this is the core of COP, right? And the sort of the idea behind the Paris Agreement is you do settle on a global target, below 2 degrees, ideally 1.5, and then you have a process through which you get these national determined contributions. At the same time, we know that the NDCs are nowhere close to, actually meeting the goal of the Paris Agreement. And if you think about net zero and interpret that as net zero 2050, for example, then that's very, very far away. So that tension will always be there. What I think on the standard level, what do you do? I think what the standard or sort of what the discussions were about is that you need both. You need to, as a financial institution, understand your local. I mean, first of all, capital is very global, right? I mean, so the banks that we look at, the 26 international banks, those are global banks. But for those that are not, it's important to take into account local context without losing, and this is, I guess, the crucial bit, the connection to the global carbon budget, which is the quantity that ultimately matters. So you need to understand your transition and your levers and your actions within both of these contexts at the same time. What I think, so ultimately, I think the ISO standard emphasizes that duality, I guess, in a way, which is great. And I think it will lead to a good amount of clarity for also users of the information, such as ourselves. But at the same time, it also requires a really thoughtful and informed way of using the standard and sort of understanding what it really means. So in that case, for example, an investor, because we work with investors, would need to look at the ISO certification, look at the documentation that requires also from the bank, and make a judgment around whether or not, in the global context and within the local context, whether the bank is striking a balance that the investor, for example, or whoever is the user of that information deems adequate, because there's no real right or wrong. But yeah, I think the connection to both local and the global carbon budget, rather than an either-or approach, will be useful.
Super helpful, Valentin. Thank you very much. Matoshi, any quick perspective on that before we go to the Q&A?
Yep, thank you. So I have 2 points. So there is, I know there's a gap between the ultimate goals and the Paris Agreement 1.5 or below 2 degrees goals, whatever, and the reality, there's a gap. But this gap doesn't necessarily mean that we need to give up to the ultimate goal. There's a gap, so we need to fill in the gaps. This is one point. The second point is that when I take a look into the original text of Paris Agreement, the Paris Agreement requires the party to submit NDC every 5 years with a progression and the highest possible ambitions. So this means that the current NDC not necessary to align with the global climate goal, which is set under Article 2.1a. What I would say. But as NDC expected to progress progress toward the global goals every 5 years, and the role of financial institution is perhaps to encourage the government to submit a more ambitious NDC. This could be engaging with the government that set and the G-Funds guideline, the financing climate solution to deliver the more promising technology, whatever. But which I hope we'll discuss later in the DIS comment resolution process.
Thank you very much. Great stuff, everybody. Thank you. Now, while you've been speaking, we've had quite a few questions and comments come in through the Q&A function. Now, a couple of these relate to the status of the ISO standards development process, where we are in this journey. I'll park those because Dan is going to give a little bit of a process update in a few moments. So there's been a question around what's the number of the standard and at what stage of development is it. So I'll leave that question for Dan to answer. Thank you very much, Paul, for rejoining us. We've got a couple of things here that be useful to get your perspective on. Any questions that we don't cover, we'll include the responses in the frequently asked questions document that Dan mentioned earlier. So we've got a couple of questions in here that talk about the interaction between voluntary adoption of an ISO standard, and the wider policy approach. So one of the questions that we have is, and maybe Valentina, perhaps you could come in on this one first. Is the absence of true polluter pays policies the main obstacle we face? Engagement resources are not unlimited, and engagements with companies seem to be hitting the wall. Can we focus resources on closing the policy gap and let the market's invisible hand do the rest? Interested to get your perspective on that, because I know that IIGCC has been quite an advocate for macro stewardship, and this perhaps falls into that space.
Yeah, no, I love the question precisely because it's the conclusion that we often reach is, okay, how much we can actually get done if policies don't move at the pace we need to. I would say yes, I mean, I couldn't agree more. At IIGCC, we do have a few initiatives. One is via the working group the policy team holds around the UK government, so engaging constantly with the UK government as well as with the EU. This is often quite useful when the conversation is quite specific. So, for example, last year we had the net zero benchmark working group had some ideas around potentially unintended consequences of the net zero benchmark regulation by the European regulation, and we engaged, and eventually that led to a workshop in which we held the views of the industry practitioners and the regulators, and that was I guess a useful exercise. And we have similar examples around real estate and other specific issues. So yeah, I guess the answer is yes, we do need more policy. One that I personally feel quite excited about is around the lobbying element, and I see that the banking standard that we've co-developed with TPI, as well as ISO standards, have some element as well on that. So I guess it's not a simple, it's a complicated answer, but what we do see is our members, or some of our members, being quite interested in facilitating that conversation as detailed and as focused as possible, as well as at the general level. The reality is it takes time. It's not one single letter, it's not one single conversation. It's just keep on engaging. But I guess our institutions like ours and standards like yours, it's not just about a standard and a PDF. It's also about the conversations and the repeating the message over and over, and the what I like to call the translation element between the language of finance, the language of engineering, for example, when it's dealing with climate physical risk, and the language of policy making, and trying to close that gap and approach it, I guess, with a lot of humility and patience, because it does take a lot of time, but process slowly, I think, is being made. I'll leave it at that.
Super helpful, Valentina. Thank you very much. Valentin, I know TPI has not only the whole of economy assessment, the banking sector assessment, but also sovereign assessment through ASCOR. That's very much homing in on climate policies. I wonder if you've got a perspective on this.
Yeah, I mean, I think just talking about ASCOR for a second. So ASCOR stands for Assessing Sovereign Climate Opportunities and Risks, and what we're really looking for is not necessarily support as such, but we're really looking for clarity, clear signs, clear policies, clear sectoral pathways, for example, as Motoshi mentioned in Japan. So that can be carrots or sticks, essentially. So carbon prices, but it can also be support for and subsidies and other kinds of policies. So, and in particular, we're looking for an integrated approach to that. So because in the past, we've seen that different parts of government have done different things without necessarily fully integrating that. In particular, for example, the finance ministries have not always been fully sort of clued into that process. So that's the clarity is the key thing that we're looking for, and I think the what's a key question, I guess, that kind of comes back again to the point around national versus global pathways is the tension between the global carbon budget and national policies, and the national policies just not adding up. And we keep talking about the gap, and I think here there really is a point around sort of compliance versus becoming a leader in the space, and sort of, you know, uh, understanding really the opportunities and the risks, so that you go from a compliance to an active role, and that then enables potentially a financial institution to you know, also exceed the national kind of circumstances, and sort of, again, so making that point around capital being really global. And as a really, really large institution, you can't really diversify away from the risks as well. So yeah, I would say that's a summary of how we look at it.
Brilliant. Thank you very much. Now, I've got just a couple of minutes before I need to hand back to Dan. If I could get 1 minute from you, Motoshi, on this question. Do you think it's necessary for governments to mandate the development and implementation of transition plans in order to meet the Paris Agreement? And do you think this can be done through voluntary measures? And then, Paul, I wonder if I could just get your perspective on a question that's actually asking about the extent to which ISO standards, both this one on transition planning for financial institutions and the net zero standard across the whole economy, can actually help distinguish between genuine climate action and greenwash. So just 1 minute on each of these before we have to hand back to Dan, so that we don't keep people beyond 1/4 past the hour. Motoshi, please.
Yep. Quick answer is no. We don't need the mandatory requirement, but it's I understand the financial industry is the kind of the more synonymous industry. There is a dynamics of the follow the peer dynamics. So there is peer pressure, sufficient peer pressure which works, and that drive at least the major financial institution developed and disclose and implement the transition plan. That is sufficient.
Thank you very much, Motoshi. And Paul, before I turn to you, Valentin, we've had a question asking for the link to your banking sector assessment. I wonder if you could just pop that in the chat to all participants. Thank you very much. Paul, over to you.
Okay, thanks, Mark. I think two of the issues that came up a lot in the working group, and as Valentin said, we're taking a lot of learnings from existing guidance in this regard. It is really ensuring credibility for transition planning and how we can visibly assure credibility in transition planning. So that's kind of one element. And the other element is around the theory of change that underpins the standard. That how is this standard going to support credible transition action, particularly in the real economy? So I think the what the draft standard, and again, I would say it's a draft standard, and you know, we're looking for insights from everyone on the call and more broadly as well. What we try to do is get that clarity between the developed organization specific transition pathway and the objectives and targets, including engagement that actually fulfill that pathway. So I know this came up in GFANZ quite a lot. It's not just taking finance emissions and saying reduce finance emissions. It's actually looking at scaling activities, financing activities to organizations that are in the process of transition and decarbonisation and actually need the capital. It's not about denying them capital. So I think that's really at the core of what we're trying to achieve in there. In terms of other ISO standards, the net zero standard that's currently been developed, again, we're having very close liaison with, and I think one of the benefits that we'll see is, or one of the problems that we'll aim to avoid is something that came up earlier about what's meant by climate solutions or what's meant by this. Actually getting people within the real economy and the finance sector using the same language and using the same definitions and getting that understanding, which I think will really help engagement as well. You know, the real economy clients portfolios will be familiar with the sort of language that's been used and hopefully understand the requirements that the finance sector's doing. So I think credibility and theory of change, scaling finance is absolutely central to what we've been trying to do.
Brilliant. Thank you very much, Paul. I'm sorry we can't continue this conversation because there's a lot of really interesting ideas bubbling up. But we're going to have to bring the panel session to a close now and hand back to Dan to walk us through the standard setting process from here. Thank you all so much. Absolutely delighted to have had the opportunity to speak to you all on the in the panel today. You've been amazing, and we look forward to continuing to engage with you and your organisations as the process continues. So thank you all so much. I'll hand back to Don.
Fantastic. Thank you so much, Mark, Valentina, Valentin, Matoshi. That was a great discussion, and thank you so much for your insights. With 4 minutes to go, thank you. To understand where we are with the development of the standard, I think it's helpful to have a very quick look on how ISO standards are developed. So the process is structured and inclusive and globally recognized, and there are 6 formal stages: proposal, preparatory, committee, inquiry, approval, and publication. And each stage involves multi-stakeholder input, and each stage is governed by clear rules around consensus and transparency. Where we are at the moment is that we have completed the first 3 stages, drawing on the expertise of financial institutions, regulators, and civil society organizations around the world. Next slide, please. We are now entering the inquiry stage, or the public consultation phase, which is arguably the most important part of the process. So from the 20th of June till the 12th of September, the draft standard will be out for public consultation. And every ISO member, national standards bodies, liaison organizations have 12 weeks to review, to vote, and to submit consensus-based comments. And to move forward, we need at least 2/3 of the committee members. So that's the committee members is the ISO TC 322 Sustainable Finance Committee. That's the International Sustainable Finance Committee. They need to approve the next version of the standard that include all the comments from the public consultation. Now, very quickly, back to the question about the number of the standard. The number of the standard is ISO 32212. So if you type in your browser ISO 32212, the page for the standard will come up from ISO, and there will also be a link to the website of the International Committee of Sustainable Finance. So next slide, please. So for this public consultation, and this really is a clear call to action for all of you, we would very much value your help to shape the final version of the standard. This is your moment to really influence the standard directly, to ensure that it reflects real-world needs, and to help to support its legitimacy and its global adoption. Now, how can you help? You can firstly engage through your national standards body. Those are your official channel to ISO. If you're affiliated with an ISO liaison organizations like CDP or GFANT, you can feed into their consultation process. Thirdly, you can join or host a roundtable. We're facilitating roundtables for financial institutions in the UK, in Australia, but also for global regulators and for different groups of policymakers. We can always help you to organize a roundtable in your own network or your own region. And finally, you can always reach out directly to Mike Henneken, who is the ISO Sustainable Finance Committee Manager, and his details are on the slide, and will be sent to you after this webinar. So I cannot stress enough that the success of this standard depends on diverse and on practical engagement. Your input will really help to ensure that this standard is practical, that it's globally relevant, and that it's ready to drive real change. So please engage with us, and thank you in advance for doing so. That brings me to the end of the webinar, and I want to thank you all for joining us today. And I want to thank you for the questions and the discussions throughout the session. I want to thank Mark, I want to thank Paul, Valentina, Valentin, and Matoshi for your insights. I hope this webinar has given you a better understanding of the role of ISO's new net zero transition planning standards and how it can support financial institutions in building credible and robust transition plans. One of the key messages we want to leave you with is that we are not reinventing the wheel. The standard we are developing is designed to complement and to formalize existing frameworks, not to compete with them. And secondly, second key message, the standards has been built with the real economy in mind. It's aligned with existing frameworks, it's flexible across regions and sectors, and it's designed to enable the transformation that we so badly need in the real economy to meet the goals of the Paris Agreement. We're now entering the public consultation phase. Your input is vital. Please get in touch with us. If you'd like to stay in touch, if you have any further questions, feel free to reach out to me directly, and the email address is on the website, or to the ISO Secretariat contacts that we've just shared. Once again, thank you for being with us today. This has been a great afternoon. We look very much forward to continuing the conversation with you, and I wish you a great rest of the day. Thank you.